This is no longer a proxy shadow conflict. This is no longer rhetoric. Missiles are now crossing sovereign Gulf airspace. American bases, once considered untouchable pillars of regional stability, are being named, targeted, tested. Al-Udeid, Al-Salem, Al-Dhafra, the Fifth Fleet in Bahrain. These are not just military installations. They sit beside the arteries of global oil, the corridors of maritime trade, the foundations of capital stability. When missiles fly over the Strait of Hormuz, markets do not wait for confirmation. They reprice risk instantly. Insurance premiums rise before dawn. Oil futures spike before headlines settle. Liquidity tightens before governments respond. And the real question is not who fired first. The real question is, what happens to the global economy if even one of those choke points closes? Welcome to boring currency reports, where the noise is filtered out and only structural risk remains. If you're wise enough to still believe in preparation over panic, then consider subscribing, the way a seasoned gentleman above 50 would quietly secure his savings before a storm. No drama, just discipline. And tell us, from which country are you watching this unfolding moment in history? And for decades, the conflict between Iran and the United States unfolded indirectly. It moved through proxies, militias, cyber operations, sanctions, and covert strikes. Markets learned to tolerate it. Investors treated it as background noise. Businesses assumed escalation would remain contained. That assumption broke the moment Iranian missiles crossed Gulf airspace and targeted American military installations directly. This was not symbolic retaliation. It was a strategic shift. Within hours of coordinated U.S. and Israeli strikes on Iranian targets, Iran's Islamic Revolutionary Guard Corps launched missiles toward multiple U.S. bases across the Gulf. The targets included Al-Udeid Air Base in Qatar, Al-Salem Air Base in Kuwait, Al-Dhafra Air Base in the UAE, and the headquarters of the U.S. Navy's Fifth Fleet in Bahrain. For the first time in years, Iran openly acknowledged targeting American military infrastructure across sovereign Gulf states. This mattered far beyond the battlefield. It meant the conflict had crossed from proxy warfare into direct state-to-state confrontation. From a strategic perspective, the selection of targets was deliberate. These bases are not frontline outposts. They are command hubs, logistics centers, and coordination nodes for U.S. operations across the Middle East. Al-Udeid alone hosts more than 10,000 personnel and serves as a forward command center for air operations across the region. Disrupting or threatening these sites signals intent, not desperation. Official statements from Gulf governments emphasized missile interceptions and the absence of casualties. From a military standpoint, interception success matters. From an economic standpoint, it does not eliminate risk. Markets do not price outcomes alone. They price probability, uncertainty, and escalation potential. Satellite imagery in the days before the strikes showed U.S. naval assets repositioning away from port facilities in Bahrain. This suggested anticipation, not surprise. Defensive systems were activated across multiple Gulf states. Airspace restrictions followed. Each of these actions carries economic cost, even before physical damage is assessed. The deeper issue is that Gulf host nations were pulled directly into the confrontation. Qatar, Kuwait, the UAE, and Bahrain did not initiate hostilities, yet their territories became active theaters. This complicates diplomacy and widens the conflict zone. Once neutral or mediating states are militarized, exit routes narrow. Iran's messaging was calculated. State-linked media framed the strikes as proportional retaliation following Israeli and U.S. attacks on Iranian soil. The narrative emphasized deterrence and sovereignty rather than expansion. This framing signals a defined threshold. Iran is prepared to accept economic pressure if core security lines are crossed. The United States responded by reaffirming defensive objectives. President Donald Trump described the earlier strikes on Iran as major combat operations, aimed at eliminating imminent threats. The language was firm, but not an announcement of full-scale war. Yet even measured language cannot reverse structural escalation once direct strikes begin. What changed fundamentally was the structure of risk. Previously, businesses modeled Middle East instability as localized disruption. Oil price spikes were temporary. Shipping delays were manageable. Currency volatility was episodic. Direct attacks on U.S. bases across the Gulf alter that framework. They introduce the possibility of sustained disruption across multiple jurisdictions at once. The geography amplifies the danger. These bases sit near the world's most critical energy corridors. Nearly 20% of global oil supply passes through nearby waters every single day. Any perceived threat to that flow forces insurers to raise premiums, shipping companies to reconsider routes, and traders to bid up prices before shortages even occur. This is how military escalation becomes economic contagion. Within hours of the strikes, oil futures reflected heightened uncertainty. Defense stocks moved higher. Airline and logistics equities showed pressure. Emerging market currencies weakened as capital rotated toward perceived safety. These reactions were not based on confirmed destruction. They were based on uncertainty. For entrepreneurs and business leaders, that distinction is critical. Economic impact does not wait for final reports. It begins the moment escalation becomes visible. The conflict has shifted from managed tension to exposed confrontation. Each additional exchange increases the risk of miscalculation. Each miscalculation increases the probability of chokepoint disruption, sanctions expansion, or broader regional shutdowns. This is not yet total war, but it is no longer contained risk. And once risk is no longer contained, the global economy begins to feel it, quietly at first, and then all at once. If missiles define the military phase of a conflict, oil defines the economic phase. At the center of this confrontation lies a narrow waterway only 21 miles wide at its narrowest point, the Strait of Hormuz. On one side sits Iran. On the other, Oman and the United Arab Emirates. Through this corridor flows nearly 20% of the world's daily oil supply, roughly 17 to 20 million barrels per day. This is not a regional route. It is a global artery. Every day, tankers carrying crude oil and liquefied natural gas pass through this strait toward Asia, Europe, and North America. China, India, Japan, and South Korea rely heavily on shipments that originate in the Gulf. If this corridor slows or closes, the shock does not remain local. It travels instantly across continents. Iran has repeatedly stated that if it is attacked or economically strangled, it could disrupt traffic through Hormuz. It does not need to fully close the strait to create economic damage. Even the perception of threat is enough. Shipping insurance premiums rise immediately. Tanker companies demand war risk compensation. Some vessels delay entry. Others reroute around Africa, adding weeks to delivery times. Each adjustment increases cost. History provides a reference point. During the 1973 oil embargo, crude prices quadrupled within months. The global economy entered recession. Inflation surged into double digits in several major economies. Today's world is even more sensitive. Supply chains are tightly synchronized. Inventory buffers are smaller. Just-in-time delivery systems dominate manufacturing. Beyond Hormuz, two additional choke points matter: the Bab el-Mandeb between Yemen and Djibouti, and the Suez Canal in Egypt. Together, these routes connect Gulf energy to Europe and beyond. Disruption at any one point can cascade through the others. The U.S. Navy's Fifth Fleet, headquartered in Bahrain, exists largely to safeguard these maritime corridors. Its operational zone covers the Persian Gulf, the Red Sea, and parts of the Indian Ocean. When its headquarters becomes a missile target, the message is strategic. Maritime security itself is being tested. Energy markets respond before diplomats do. A sustained disruption pushing oil above $100 per barrel would have immediate consequences. Transportation costs would rise. Airlines would face fuel pressure. Shipping companies would increase freight charges. Manufacturers dependent on petrochemicals would see input costs climb. For developing economies, the pressure is even greater. Many import the majority of their fuel. A 20 to 30% increase in oil prices widens trade deficits and weakens currencies. Central banks, already balancing inflation control and economic growth, face limited flexibility. This is how war risk transforms into inflation risk. In advanced economies, higher energy costs feed directly into consumer prices. Food becomes more expensive due to transportation and fertilizer costs. Electricity prices increase in countries reliant on gas imports. Inflation expectations begin to shift upward. Central banks then face a dilemma. If they raise interest rates to control inflation, borrowing costs increase for businesses and households. If they hold rates steady to protect growth, inflation may accelerate further. Entrepreneurs operating on thin margins feel this first. Freight invoices increase, supplier contracts are renegotiated, customers delay purchases due to uncertainty, working capital requirements expand. Large corporations can hedge oil exposure using futures markets. Small and medium-sized businesses often cannot. They absorb the cost directly. There's also a secondary layer of risk: physical supply chain congestion. If vessels slow transit through Hormuz or reroute away from Bab el-Mandeb due to security threats, port backlogs emerge. Containers pile up, delivery schedules stretch, production timelines shift. The 2021 Suez Canal blockage demonstrated how a single vessel could disrupt nearly $9 billion in trade per day. A military conflict affecting multiple choke points would be far more severe. Insurance markets are another pressure point. War risk premiums for shipping through conflict zones can multiply several times over within days. Those costs are passed along the supply chain, from shipping firms to wholesalers to retailers. The result is quiet but persistent economic tightening. The Strait of Hormuz is not just a military flashpoint, it is a pricing mechanism for global stability. The mere possibility of disruption alters investment decisions, inventory planning, and capital allocation strategies worldwide. This is why energy corridors are often described as strategic leverage. They allow smaller regional conflicts to exert global influence. Business leaders who underestimate this linkage mistake geography for distance. In reality, a missile launched near the Gulf can raise operating costs in Europe, Asia, and North America within hours. The energy artery does not need to be severed to cause pain. It only needs to be squeezed. And in times of direct state conflict, even a slight squeeze can ripple through the entire global economy. Financial markets. Under stress, capital flight, safe havens, and risk compression. When missiles are launched, financial markets react before governments issue full statements. Capital does not wait for clarity. It moves toward safety. Following Iran's strikes on U.S.-linked military infrastructure across the Gulf, oil prices rose sharply in futures trading. Even a 5 to 10% move in crude within hours signals stress. For energy-importing nations, that shift translates immediately into higher projected inflation, but oil is only the first signal. Gold prices typically rise during geopolitical escalation. Investors treat gold as a store of value during uncertainty. In previous Middle East crises, gold has gained between 3 and 8% in short windows as risk perception increased. This movement reflects defensive positioning rather than speculation. At the same time, equity markets tend to weaken, especially in sectors sensitive to fuel costs and global trade. Airlines, shipping firms, and manufacturing companies often experience early sell-offs. Investors reduce exposure to industries dependent on stable logistics. Currency markets also respond quickly. In periods of war risk, the U.S. dollar frequently strengthens due to its reserve status. Capital flows into U.S. Treasury bonds, which are viewed as safe assets despite America's direct involvement in the conflict. This paradox reflects trust in the depth and liquidity of U.S. financial markets. Emerging market currencies, however, face pressure. Countries dependent on energy imports see their trade balances deteriorate when oil prices rise. Investors withdraw capital from higher risk jurisdictions and rotate into safer markets. This process is known as capital flight. For Gulf economies themselves, the situation is complex. On one hand, higher oil prices increase government revenues for exporters like Saudi Arabia and the UAE. On the other hand, missile strikes within the region introduce sovereign risk. Infrastructure hubs such as Dubai's Jebel Ali port or Bahrain's financial district operate on perceptions of stability. Even limited strikes can alter long-term investment confidence. Sovereign wealth funds in the Gulf manage trillions of dollars in global assets. If regional instability intensifies, these funds may rebalance portfolios defensively. Large reallocations can influence global equity and bond markets. Risk compression becomes visible in credit markets as well. When uncertainty rises, lenders demand higher yields to compensate for perceived danger. Corporate bond spreads widen. Companies with weaker balance sheets face refinancing pressure. Debt that was affordable under stable conditions becomes expensive. This matters because global corporate debt exceeds $90 trillion. Many firms depend on rolling over short-term borrowing. A sudden increase in yields reduces flexibility. Businesses already operating on narrow margins may face liquidity stress. Banks also tighten lending standards during geopolitical shocks. They increase collateral requirements. They shorten loan durations. They become cautious about sectors exposed to shipping, aviation, or cross-border trade. For entrepreneurs, the effect is practical and immediate. Access to capital becomes more selective. Investors prioritize resilience over expansion. Growth plans are reassessed. Stock market volatility increases during such periods. The VIX index, often called the fear gauge, typically spikes when geopolitical tensions rise. Elevated volatility discourages risk-taking and reduces IPO activity. Startups planning public offerings may delay them. Insurance markets mirror this pattern. Political risk insurance premiums increase. Companies operating in high-exposure regions must budget more for coverage. Those without protection face heightened vulnerability. Another important dimension is commodity-linked currencies. The Canadian dollar, Norwegian krone, and other resource-linked currencies may strengthen with rising oil prices. Conversely, oil-importing countries such as India or Turkey often experience currency depreciation during energy shocks. Capital behaves according to survival logic. It consolidates in large, liquid markets. It avoids peripheral risk. It rewards balance sheet strength. Technology stocks, especially those dependent on global supply chains, may experience volatility if semiconductor shipments or rare material flows appear threatened. Defense contractors, by contrast, often see upward price movement as governments increase military spending. This redistribution of capital is not random. It reflects a reevaluation of future cash flows under stress. For business leaders, understanding this pattern is essential. Financial market stress often precedes real economic slowdown. Tightened credit today becomes reduced hiring tomorrow. Reduced hiring becomes lower consumption later. The sequence begins quietly. Capital flight does not require panic headlines. It requires only rising uncertainty. And uncertainty, once introduced at the level of direct state conflict, can spread faster than any missile. In such environments, liquidity becomes strategic. Cash reserves offer flexibility. Debt exposure becomes riskier. Geographic diversification gains importance. Markets under stress are not chaotic. They follow patterns shaped by history. The question for decision makers is whether they recognize those patterns early enough to adjust, because once risk compression accelerates, repositioning becomes far more expensive. Strategic outlook, escalation scenarios, and economic positioning. At this stage, the conflict stands at a strategic crossroads. The missile strikes on U.S.-linked bases across the Gulf have altered the risk structure, but the final trajectory remains uncertain. For business leaders and investors, the question is no longer what happened. The question is what happens next. There are three realistic pathways. Scenario 1, controlled escalation. In this outcome, both sides exchange limited strikes but avoid targeting critical civilian infrastructure or fully closing maritime chokepoints. Diplomatic backchannels remain active. Energy flows continue with heightened security. Oil prices may rise temporarily to the $90 or $110 range, but stabilize as markets gain clarity. Under controlled escalation, volatility remains elevated but manageable. Businesses experience higher insurance costs, modest freight increases, and temporary currency fluctuations. Central banks monitor inflation but avoid drastic policy shifts. Economic growth slows slightly but avoids recession. This scenario carries moderate probability and moderate impact. Scenario 2, prolonged regional conflict. Here, retaliation cycles continue. Missile exchanges expand. Proxy groups in the region increase activity. Shipping lanes face intermittent disruption. Insurance premiums rise sharply. Oil prices push beyond $120 per barrel and remain elevated for months. At that level, inflationary pressure intensifies globally. Energy importing nations face widening trade deficits. Emerging markets with weak currency reserves experience financial strain. Governments increase defense spending, diverting funds from infrastructure and social programs. Corporate borrowing costs rise as credit spreads widen. Equity markets struggle with sustained volatility. Consumer confidence weakens as fuel and food prices climb. This scenario has lower probability than controlled escalation, but carries significantly higher economic impact. Scenario 3, strait disruption or closure. This is the most severe case. Iran attempts to significantly disrupt traffic through the Strait of Hormuz. Even partial blockage reduces global oil supply by millions of barrels per day. Oil prices could spike toward $150 or higher in a short window. Strategic petroleum reserves may be released, but such reserves are temporary buffers. Global inflation would accelerate sharply. Central banks would face a stagflation dilemma, rising prices combined with slowing growth. Stock markets could decline rapidly as investors price recession risk. Airline, logistics, and manufacturing sectors would face immediate margin compression. Energy producers and defense contractors might benefit, but overall economic activity would weaken. This scenario carries the lowest probability, but the highest systemic impact. For entrepreneurs and executives, scenario planning is not about predicting headlines. It is about preparing balance sheets. Liquidity becomes the first line of defense. Companies with strong cash reserves and low debt can withstand temporary shocks. Those dependent on continuous refinancing face greater vulnerability if credit conditions tighten. Energy exposure should be assessed carefully. Businesses heavily reliant on fuel-intensive transport may consider hedging strategies. Long-term supply contracts with price ceilings can reduce volatility. Geographic diversification also matters. Firms overly concentrated in one region face operational risk if shipping lanes are disrupted. Alternative suppliers and backup logistics routes provide resilience. Insurance coverage deserves review. Political risk insurance and trade disruption policies become valuable during instability. While premiums may rise, the cost of unprotected exposure can be far higher. Leaders should also monitor central bank policy responses. If oil-driven inflation persists, interest rate adjustments may follow. Higher rates increase debt servicing costs and reduce expansion capacity. Strategic expansion plans should incorporate conservative financing assumptions. Opportunities will emerge alongside risks. Defense spending typically rises during prolonged conflict. Cybersecurity, energy infrastructure, and domestic manufacturing may attract increased investment. Businesses aligned with supply chain resilience can benefit from structural shifts. However, opportunity must not obscure caution. Wars reshape capital flows faster than political speeches reveal. The global economy is interconnected. A missile strike near the Gulf can alter pricing decisions in factories thousands of miles away within days. The escalation between Iran and the United States is no longer theoretical. It has entered a direct phase. Whether it stabilizes or intensifies depends on political decisions still unfolding. For decision makers, the priority is disciplined positioning. High impact, low probability risks require contingency planning. Moderate impact, high probability risks require immediate adjustments. Ignoring either can expose organizations to avoidable shocks. Economic power in the modern world is deeply tied to trade routes and energy security. When those arteries are threatened, volatility follows. Prepared leaders do not panic. They analyze, adjust, and preserve optionality. Because in periods of geopolitical uncertainty, survival belongs not to the fastest mover, but to the most structurally prepared.